Good morning, everyone. Good morning, everyone. All right, friends. So I'm live again. Give me a minute. I'll just set up everything and we'll start off with problem solving. Can you please go through this question in the meanwhile? Sure, Komati RC. I will do that. I will share the link in the Telegram page. Okay. All right, friends, we learned all the basics of options earlier. Now let us go to advanced part. Let's start cracking some good number of questions on options. All right. Everyone, please read through this question, understand this question, after which we will do it together. All right, friends, shall we do it together now? Here they are asking us to find out the expiry date cash flow, uh, investment value. Friends, investment value is also known as gross profit or GP and net profit for four combinations. Buy a call, write a call, buy a put, write a put. All right. So this is something similar to the concept that we learned earlier. So let me start off with the first working note. Working note number one, buy one call. Okay. S1, E1, action, status, GP, premium, NP, and one new thing that we are learning over here which is called as expiry cash flow. What is expiry cash flow? I'll explain to you later. So what are the prices that are mentioned over here? They have told 50 to 70. Am I right? Okay, so let me just put the price 50, 55, 60, 65, 70. And what is the exercise price? Have they told the exercise price to be 60? I have a right to buy at 60, outside market 50. Laps, laps, exercise or laps, exercise, exercise. All right. So the status will be out of the money, at the money, in the money, and in the money. 0, 0, 0. Here I'll get 5, here I'll get 10. The premium is told to be how much? 9. So I'll get the net profit as minus 9, minus 9, minus 9, minus 4 plus 1. Can you please put up till here in your books now? Lecture also in the RPL Telegram page. So whoever is there, please you can view it. Please write down, and once you are done writing, let me know. Alright friends, this is buy a call. Now same way you have to do write a call. Friends, as I did earlier, wait, before that let me explain to you the meaning of expiry date cash flow. You can write down below that. Expiry date cash flow is basically nothing but cash flow in the options market which occurs on expiry. Can you please write down till here in your books? Yes, Janvi, I assume the class is working properly. Please check. Just refresh your settings. Alright friends, so basically here if you see, once I lapse in the option market, no cash flow will happen. No happen. But when you exercise, I am exercising a right to buy, so I'll buy at what price? Minus 60. Am I right? Here it will be either 0 or minus 60. This is what we call it as expiry date cash flow. Premium will not come over here because premium takes place at the beginning. It doesn't happen on expiry. Can you please write down till here in your books now? Alright friends, have you all put up till here in your books? Now let me just explain to you how to do write a call. I will do it the same way how I did earlier friends. First thing what I will do is this part will change. Rest will remain the same. Am I right? This part will change. Okay. Now I will take a reading pen. So it is not buy a call now. It is going to be write a call. Okay. This will be minus. Premium will be plus 9. Okay, so here I'll get 999 plus 4 minus 1 0 0. It will be 0 or plus 60 now, because if the other fellow buys, what will I have to do? I will have to sell. Can you write down this also in your books? Ramani, that's what I said. Premium is paid upfront. It is not an expiry cash flow. So we don't have to bother about that. Can you please write down this neatly as a second working note? Alright friends, have you put up till here in your books? Okay, so I'll now go to the next one. The next working note will be what? Buy one, put. Okay. S1, E1, action, status, GP, premium, NP, expiry date, cash flow. So the exercise price remains the same. This is 50, 55, 60, 65, 70. Okay. I have a right to sell at 60 outside market 50. I will exercise in the money, exercise in the money, exercise bar lapse, lapse, lapse at the money, out of the money, out of the money. All right. So my GP over here will be 10, 5, 0, 0, 0, and I think the premium is 1. So I'll get the answer as 9, 4, minus 1, minus 1, minus 1. Since I am exercising, I will sell, I will make 60 here, 60 here, 0 bar 60, 0, 0. Friends, write a put. Can you please do it on your own now? I will not help you over there. Please do that on your own. Buy a put I have given, write a put, do it on your own. Once you are done, please let me know that you are done. Okay. Friends, are you done with the write up put also? I have not done that on the board, but I want you to do it on your own. By now, you would have understood the concept of that, right? So basically, you will know what will change now. Correct? Alright, friends. So we are done with this part. Okay. Now let us do one thing. So we are done with this question also. Okay. So we are done with this question also, friends. If you're going by writing a put, I'll just quickly tell you what the answer would be so that you don't have any confusions over there. Okay, this will all be minus, minus, minus. This will be minus, minus, plus, plus, plus. Okay, so all the signs will change from here onwards. The left side will remain the same. I hope you are clear with that part. Okay, so we are done with this question, friends. Let's go and check the next question. Okay, next question is straddle. Let's write down the next concept heading in your books. Straddle. Friends, there are actually two types of straddle. One is called as buy a straddle, and the other one is called as selling a straddle. Okay, this is actually a combination. This is buy call and buy put. So two things are coming together. This one is sell call and sell put. Can you write down till here in your books now? AJ, payoff graph is not relevant from exam point of view. You just have to draw the graph. Since it is not relevant, I am not straining on that. Okay. Alright friends, if you are clear with this, can you please take the question on straddle? Yes. I'll give you 2 minutes time. Can you please read through the question and understand the question? After that, we will do it together. Friends, just give me a minute. I just need to copy one video. You just read the question. In the meanwhile, I'll just get back. Alright friends, can you please read through this question on your own so that we can do it and finish it off? Alright friends, let's write down the basic data together now. Working note 1, basic data. Alright, point number A. Friends, one twist over here. How is the exchange rate given over here? Is it given in capital letters? And is there no equal to? So I told you slash will be equal to, deemed to be equal to. Am I right? So here, the spot dollar bar euro will be 1.20 dollar bar euro. Point number B, spot rupee per dollar is given below as how much? 44.80 rupee per dollar. Then they have given a table where they have given the exercise price, premium, expiry date. So expiry date is July 19 for dollar bar euro, September 19 for rupee bar dollar, and the original date is 19th April. So 19th April to July is how many months? May, June, July, 3 months. So can I say duration of dollar bar euro options will be how many months now? It will be 3 months. Similarly, how many months is July, April to September? 5 months. So duration of rupee per dollar options will be how many months? It will be 5 months. Can you please write down this in your books now? Alright friends, have you all put up till here in your books now? Okay. If you have put up till here in your books, let's come down. Now they are asking trader sells a straddle expiring at 3 months. Now tell me, what is the trader doing? Selling a straddle or buying a straddle? He is selling a straddle. If he is selling a straddle means it will be sell a call, sell a put. And they have told expiring at the end of how many months? 3 months. So when they say 3 months, it means dollar bar euro options or rupee bar dollar option. It will be dollar bar euro. Okay. They are asking you to find out the gain or loss if the spot rate turns out to be 1.29. So I'll write down the next working note. Gain or loss in a 3 months dollar bar euro straddle S1 E1 action status GP premium NP. Okay, so here it will be sell a call and the other one will be sell a put, since you are selling a straddle. S1 is a spot price on expiry. Is that turning out to be 1.29 and 1.29? E1 is the exercise price. What is the exercise price told over here? It is told as 1.2. Okay, so it will be 1.20, 1.20. Selling a call means we are selling a letter so that the other fellow can buy the share. Other fellow has a right to buy at 1.2, outside market 1.29, other fellow will exercise. Okay, here other fellow has a right to sell at 1.2, outside market 1.29, other fellow will lapse this. So this will be in the money, this will be out of the money. So the other fellow will make a profit of 0.09 over here. Am I right? So for me, this is going to be a loss. Lapsing, nothing will come. What about the premium? 0.035. This will be inflow. 0.04 will also be inflow. Okay. So how much is 0.09 minus 0.035? I'll get the answer as minus 0.055. My net gain or loss will be minus 0.015. Now tell me, straddle is giving me a profit or a loss? It is giving me a loss. So should I sell a straddle? No. We'll write down since selling a straddle results, sorry, we just have to say selling a straddle results in a loss. That's all. Can you write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay. Once you're done, please write and let me know that you are done. Okay. Alright friends, so we are done with the first part. Let us read through the second part of the question now. What strategy will give a profit to the dealer if 5 months later the expected spot rate turns out to be 45 rupees per dollar? Now they are showing 5 months. So when they are saying 5 months, it means what? It is rupee per dollar or dollar bar euro. It is going to be rupee per dollar. And the spot rate on expiry is told to be how much now? 45. Okay friends, so let's do one thing. I'll write down the next working note heading. Strategy which will give profit to the dealer. Okay. Friends, ideally we are having four strategies over here. Particulars. One can be buy a call, sell a call, buy a put, or sell a put. S1, E1, action, GP, premium, net profit. The spot price on expiry is how much? 45. The exercise price is told over here as how much, everyone? 44.8. So I have a right to buy at 44.8, outside market 45, I will exercise. Alright. I have a right to sell at 44.8, outside market 45, I will lapse. So here my profit will be 0.2 minus 0.200. Premium for call is 0.12. So this will be minus 0.12 plus 0.12. Other one is minus 0.04 plus 0.04. So my profit will be 0.08, 0.08 minus 0.04 plus 0.04. So tell me friends, which is the one which is giving me the best profit over here? This one. So I'll write down, we should buy a call to maximize profit. Alright friends, can you please write down till here in your books now? Alright friends, are you still writing? Okay. Fine friends, if you are done with this, so we are done with this question also. Next we go to a very important concept. Write down the next heading in your books. Option valuation model. There are mainly three parts coming inside this. The first one is called as a risk neutral model. Second one is called as the binomial model. And the last one is called as the Black-Scholes model. Can you please draw this chart in your books now? Friends, these models are actually very easy. The problem is the terminology option valuation model creates confusion. Ideally, the heading over there should be how much premium the writer should charge. This is the question which we are trying to solve. Can you please write down like this in your books now? Yes, Gauri Shankar, what you said is right. The profit will be, I think I missed out to tell that, 0.08 into 15 lakh dollar. So that will be 1,20,000 rupees. You can put it that way. Okay. Alright. Can you please write down this in your books now? Alright friends, now let's do this. Friends, to learn this concept of options, I will give you three examples. Example 1 and example 2 will be stupid examples, but once you understand the grip of these two, you will be easily be able to understand the logic of risk neutral model. Many of the books do not stress on what the logic is, because of which people find it difficult. Here we will stress on the logic. Let me take two people from this classroom for this example. Alright. Uh, I will take Cherian as one of the persons, and I will take Gauri Shankar. Okay. Let us assume that Cherian is going to be a call buyer. Okay. Whereas Gauri Shankar is going to be a call writer. Let me put up the details of this call. Let us say the spot price today is turning out to be 100 rupees. Okay. If you put the money in bank, you will surely get 10%. Let us assume for time being that life is turning out to be 1 year. Alright. Cherian has a right to buy at 110 rupees at the end of 1 year. Alright. Now the question, only one thing that we need to ask is, how much premium should Gauri Shankar charge? For this example, we will assume that Gauri Shankar is an astrologer. What do you mean by astrologer? This guy has magical powers, and with this magical powers he can actually predict the future, assume. Now friends, suppose Gauri Shankar knew what will be the actual price after 1 year, then he will definitely come to know how much premium he should be charging. Now tell me, what is the nature of Gauri Shankar? He is an astrologer, friends. So, to predict the future, Gauri Shankar will get up in the morning at 3 o'clock. After getting up at 3 o'clock in the morning, he will wear his turban. He will take and burn some fire in front of him. Then he will take some ashes in his hands. He will close his eyes. He will say some magic, and after which, whoosh, he will put that powder inside the fire, and the moment he puts this powder inside the fire, what will happen? One smoke will come out. The smoke will tell that the price after 1 year is going to be 150 rupees. If the price is going to be 150 rupees after 1 year, that means will Cherian buy the option or sell the option? Or lapse or exercise? He will exercise. By exercising, what is the profit that Cherian will make? Cherian will make a profit of how much over here? 40 rupees profit. So, at least Gauri Shankar can charge a premium of how much over here? He can charge a premium of 40 rupees. But friends, when do you charge premium? Now or on expiry? You charge it now. So the premium to be charged now will be present value of 40. How much is 40 divided by 1.10? 36.36. Hence, if Gauri Shankar is an astrologer, the premium to be charged today will be 36.36. Can you please write down this in your books now? Alright friends, once you're done, you let me know. Alright, so example 1 is over. Now let's take example 2. Example 2, same thing. Cherian is going to be the call buyer. Gauri Shankar is going to be a call seller. Alright. In the first example, Gauri Shankar was an astrologer. In the second example, Gauri Shankar is doing articleship under an astrologer. So basically he is learning astrology. He is not very good at this. Okay. So the details will be the same. S0 is 100. RF 10%. Life is going to be 1 year. He has a right to buy or right to buy at 110. How much premium should he charge? So now friends, Gauri Shankar wants to predict the future. For predicting the future, earlier he was a professional astrologer. Now he is doing articleship under an astrologer. So tell me friends, what will Gauri Shankar do now? He will get up in the morning at what time? 3 o'clock. After getting up, what will he do? He will wear his turban. After that, what will he do? He will burn fire. He will take some ashes, close his eyes. He will say some magic, and after that, whoosh. But friends, something went wrong with the magic now. Since he is not an expert, instead of one smoke coming out, two smokes started coming out. The first smoke told him if the spot price is 100, the first smoke told him that price after 1 year will be 150. Second smoke told him the price will turn out to be only 90. If it goes up, he will make a profit of 50. If it falls down, he will make a loss of 10. Now Gauri Shankar is totally confused. He doesn't know what to do. So what Gauri Shankar did was, he took some more powder, closed his eyes, said some magic, and after that, whoosh. Again two smokes came out. The first smoke told that there is a 60% chance price will be 140, 150, 40% chance the price will be 90. Friends, this is a table which I get in the spot market. But right now, are we dealing in spot market or option market? We are dealing in option market. So I will draw one more decision tree for the option market. Alright. Here, I have a right to buy at what price? 110. If the price goes up to 150, I will exercise, I will get 40. If the price falls down at 90, I will lapse and it will become 0. So there is a 60% chance Cherian will make a profit of 40. 40% chance his profit will be 0. So his expected profit will be 40 into 60 plus 0 into 40, that is 24 rupees is the expected profit, divided by 1.1. The minimum premium to be charged today will turn out to be 21.81. This is example number 2. Can you write down this in your books now? Just a second, friends. Alright friends, once everyone is done, please chat and let me know that you are done so that I can go to example number 3, which is the final example. Ramani, ideally speaking, if the buyer makes more profit, I can charge more premium. Buyer makes less profit, I can't charge so much premium. Buyer will never come to me. That's why. I'll come to your part, Ramani. I mean, once I complete example 3, you will get the whole picture clear. Alright? Fine, friends. Have you all put up till here in your books? Okay. Now I will go to example number 3. Friends, example number 3. In this, Gauri Shankar is not an astrologer. He is not doing articleship under astrologer. He is doing articleship under a CA. He has got no magical powers at all. Let me put the same details once again now. S0 is how much? 100. RF is how much? 10 percentage. Life is 1 year. E1 is 110. We need to find out the premium. Friends, now what Gauri Shankar will do is, he will take the last 10-year data and then he will draw a table which is x, p, x minus x bar, p into x minus x bar the whole square. Can you tell me once he uses that table, what is the answer that he gets over there? He will get the standard deviation. Let us say he gets a standard deviation of 20. From that, he can now draw a decision tree which comes under the spot market. Okay. So standard deviation 20 means if the spot price today is turning out to be 100, at the end of 1 year, the price can be either 120 where he makes a profit of 20, or the price can fall down to 80 where he makes a loss of 20. Now he got the price at the end of 1 year. It can be either 120 or 80. But he does not know what is going to be the probability. For probability, he will use a simple logic. Share market, price can go up or price can fall down. The average of the price going up and coming down, I repeat, the average of the price going up and coming down should at least give me the money that I'm getting from bank. What is the RF told over here? 10%. So can I say I should at least get 10 rupees as an average return from the market? Otherwise, I will never put my money in the market. It's better I put my money in bank. So can I say 10 rupees should be nothing but 20p plus minus 20 into 1 minus p? Am I right? So if I put it this way, it will be 10 is equal to 20p minus 20 plus 20p. So can I say 30 is equal to 40p? Therefore, p is equal to 3 by 4, that is 75%. So I also derive the probability. Once I get the probability from the spot market, I will go to the option market. Okay. Here I will draw a rectangle like this. E1 is equal to how much? 110. If the price goes up to 120, I will exercise and I will make a profit of 10. Exercise. This has got a how much percent probability, friends? 75% probability the price will go up to 120. Or the price can fall down to 80. If it falls down to 80, what will I do? I will lapse. Having a 25% probability, I will get 0. Therefore, the expected profit of Cherian will be 10 into 75%, that is 7.5. Therefore, premium to be charged will be 7.5 divided by 1.1, that is equal to 6.81 rupees. This model in which I first find the probability in the spot market and then value in the option market is what we call it as the risk neutral model. Friends, this 6.81 is something what you have already learned on day number 1 that I taught you. Everybody interact with me. How do you value any asset? Value of an asset is present value of future cash flow that the asset can generate. Similarly, value of the option is also nothing but the present value of future cash flow that the option can generate. Here, option is able to generate 7.5. I can charge a premium of 6.81. If option was able to generate 100, I can at least charge 90 rupees premium. So value of an option is also the present value of future cash flows. This is what Ramani you asked, and I hope the answer I have given to you. Okay, can you write down this in your books now? Balaji, P means probability. Sorry, I think I forgot to mention that. I thought that was implied. P is probability. 1 minus P is probability of the price falling down. Sign, which part should I come again? Can you please write down? I will repeat the whole logic once again after that. P calculation is probability. Yeah, that's what I have done below. Once you write it down, you will understand that. Oh, Sai Reddy, you want the calculation for P? I will repeat it once again. Okay. Friends, once you write down, I will repeat the whole part once again. Okay, have you put up till here in your books? Can you write down this also in your books now? Alright friends, have you written down till here? I will repeat the whole thing once again. Now friends, the question what we are trying to answer is, what is the minimum premium that we should be charging? For which so many details are given over here, and from this we tried finding out the standard deviation. Standard deviation is basically plus or minus. So if the spot price is 100, the actual price will be either 120 or it will be 80. Once we got this, we need to find out the probability. So I kept a simple logic. I am putting 100 rupees in the stock market. Maybe I'll draw that and show you. I have 100 rupees with me. I have two options with this. Option 1, I put this money in bank. If I put this money in bank, I will get 10% or I will get 10 rupees. Now I can put this money in the stock market. Alright. If I put this money in the stock market, I will either make plus 20 or I will make minus 20. This has got some probability, this has got some other probability. Am I right? Whatever be the probability, the average of this should at least give me 10 rupees. If the average is giving me less than 10 rupees, then what will happen is it's better I put my money in bank. From this I create this equation that 10 rupees should be equal to 20p plus minus 20 into 1 minus p. Can you please put this also in your book so you become much clear on what I am trying to say? Rest is purely solving of the equation. Friends, this handout will be coming in the website very soon. I've spoken to my team, they will help me out to do this. Alright friends, have you put up till here? So then we put this equation, we got the answer as 75%. Once you get 75%, then in the option market we did this and we got the profit of the other guy is 7.5. So I should at least charge a premium of 6.81. Alright? Or we can just give a heading like this, okay? Value of an option is the present value of future cash flows which the option can generate. So we normally go by two steps over here. Step number one is what I call it as probability, which we derive from the spot market. Probability is always derived in the spot market. Step number two, we find out the expected value, that is outcome into probability, in which market? Option market. Can you please write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay. So we are done with this part also. Now write down the next concept heading. Binomial model. I will first tell you the formula and then the logic. Okay. The formula is premium to be charged is equal to Cu into I minus D divided by U minus D plus CD into U minus I divided by U minus D whole divided by I. This formula looks tricky, but it's very logical and it's very, very easy. Alright friends, I'll explain the meaning of this first. Cu means value of call option if the price goes up. CD means value of call option if the price comes down. Alright. I means 1 plus interest rate. Okay. Remaining I'll give you in the next page. Can you write down till here first? Alright friends, if you have put up till here, the next word is U. U is basically the proportion of the higher price to the spot price, whereas D is the proportion of lower price to the spot price. Alright, can you please write down till here in your books now? Alright friends, have you all put up till here in your books? I'll now show you the meaning of this. So Cu into I minus d divided by u minus d plus Cd into u minus I divided by u minus d whole divided by I. Cu means when the price goes up. In my example, the price went up to 120. Am I right? So at that time you will exercise, you will make how much? 10 rupees into 1.10, that is 10% interest rate. D is down price. Down price was how much? 80 by 100. Am I right? Whole divided by U was how much? 120 by 100 minus 80 by 100 plus CD is 0. When the price falls down, we lapse the option, it becomes 0 into, I know it is 0, but still for you to understand the logic, I am doing this. 120 by 100 minus 1.1 divided by 120 by 100 minus 80 by 100 whole divided by 1.1. Okay, that will be 10 rupees into 0.3 divided by 0.4 plus 0 into 0.1 by 0.4 whole divided by 1.1. If you solve it, you will get the answer as 6.81. Are you familiar with this number? This is exactly the same number we got under institutional model also. Write down, then I'll tell you how this answer tallies with that answer. Friends, now I will tell you how this answer tallies. If you see, in the end I have got 10 into 0.3 by 0.4 is nothing but 0.75 plus 0 into 0.25 whole divided by 1.1. So I am getting the answer as 7.5 divided by 1.1. Is this exactly the same answer what I got earlier also? Or friends, can I say this whole equation is the equation to find out what is the probability if the price goes up? And this is the probability if the price goes down. Am I right? So basically I minus d divided by u minus d is the methodology used here to find out probability. Under risk neutral model, what we were doing was we were creating equations. Like we made equation over here. This gave us 75%. Here I don't have to do this. I just have to put this and I will get the answer as 75%. Are you getting my point? So friends, in simple logic, the formula is Cu into probability of price going up plus CD into probability of price going down, whole divided by I is nothing but present value. Can you write down this in your books now? Okay, I hope you have put up till here in your books, friends. So, friends, I will just tell you this ID minus D divided by U minus D. I'll just maybe explain to you in one more manner. Look over here. This is divided by U minus D. This is also divided by U minus D. So, can I say we have a common denominator over here? I minus D and U minus I, when you do, I and I gets cancelled. Do I get U minus D divided by U minus D? That is nothing but 1. Or can I say this plus this will give me a total of 100 percentage. So this is 75%. This will give me 25 percentage. That is the logic. So friends, now for you to remember, don't remember as I minus D divided by U minus D. It will become too long. Keep in your mind a short form. IDUD. Come on, repeat 5 times with me. IDUD. 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 And the second one will be what? UIUD. Everyone repeat. UIUD. 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 Everybody clear? So now the overall formula is easy. CU into IDUD, CD into UIUD, the present value, that is whole divided by I. Have you understood the logic of binomial model also, friends? In that case, can we start cracking some problems on this? Everyone, please take question number 3 now. This is a question which you can solve it using risk neutral model also and binomial model also. I will give you 5 minutes school of time. Can you take a rough book and try doing it on your own? Because once your brain works, it will be very easy for me to explain this. Otherwise, you will find it very, very demoralizing. Alright. So your 5 minutes starts now. Please take this question and try doing it on your own. Friends, shall we do it together now? Alright, let's do it together. Working note 1, basic data. So here they have given the spot price, which is 420. Maximum price is given as how much? 500. Minimum price is given as how much? 400. RF is said to be 8%, that's for 1 year, so it will be 2% continuous compounded. So friends, from this actually I can find out the e raised to rt value. That will be 1.02 plus 0.02 square divided by 2. That is 1.0202. This is already, friends, given in the question over here. Alright. So if this I have got, CCR will be nothing but this minus 1. CCF minus 1, that is 2.02%. Alright, they have given the duration as 3 months, which I already have mentioned earlier. And they have given the exercise price as how much percentage? Not percentage, it is 450 rupees. Can you always write down the basic data in your books now? Alright friends, now I will first solve it using risk neutral model. Value of call using risk neutral model. Friends, under this model, as I told you, we are going to go by 2 steps. Step number 1 will be probability, which we will find in which market? In the spot market. Alright, so the probability in the spot market would go like this. I will draw a decision tree. Spot price is how much? Is it 420? Can go up to 500, fall down to 400. Here you make a profit of 80, here you make a loss of. I don't know what are the probabilities. If I put this 420 in bank at 2.02%, I will get at least 8.48. So can I say 8.48 is equal to 80p plus minus 20 into 1 minus p? So 8.48 is equal to 80p minus 20 plus 20p. Therefore, 8.48 and that will come, this will be 28.48 is equal to 100p. So P will be equal to 28.48%. So 1 minus P will be 71.52%. Can you write down till here in your books now? Deepika, CCR is continuous compounded rate. CCF is continuous compounding factor. I took that when I was doing futures. Alright friends, have you all put up till here in your books? Alright. Okay, Akshat sir, I will tell you how this 8.48 came. 8.48 is nothing but 420. If I put in bank, I will get 2.02 percentage. That is equal to 8.48. You want me to repeat it again? See, 420, I have two options. I can either put in bank or I can put in the share market. If I put in bank, I will at least get 2.02 percentage. So I'll get 8.48 rupees. So when I put in the stock market, the average I should at least get 8.48. That is how this 8.48 has come. Are you clear with 8.48 or should I repeat once again? Sai, I think your answer is approximately right, not precisely 14, it is I think 14.1 or something like that. Akshat Manasi, are you clear with 8.48 or should I repeat once again? Alright, so I hope you are clear with that. Okay, once I get step 1, I will go to step 2 where I will write down value, or I'll call it as expected value in the option market. Friends, here I will draw the another decision tree. E1 is 450. Now the price can go up or the price can fall down. The price can go up to 500. I will exercise, I will get 50. The price can fall down to 400. I will lapse. 28.48%, 71.52%. Therefore, expected profit at the end of year 1 will be 50 into 28.48%, that is 14.24. Therefore, premium to be charged will be 14.24 divided by 1.0202. The answer will be 13.95. Can you please write down this also in your books now? Sri Lakshmi, 14.24 you have to discount. I think that one step you must have missed out. Alright friends, have you all put up till here in your books? Alright friends, so we are done with the first part. Exam only this much was asked, but I will just give you one more working note where I will give you solution using binomial model also. So in one shot you can tally and you will get the same answer using any of these models. Okay. So here the formula will be CU, that is price going up. It will be 450 is the exercise price. 1 minute. 50. If the price goes up, I will be making 50 into IDUD. 1.0202 minus D will be the down price, that is 400 by 420 whole divided by 500 by 420 minus 400 by 420 plus 0 whole divided by 1.0202. Try solving this on your own. You will get the same answer of 13.95. Can you write down till here in your books now? Alright friends, have you all put up till here in your books? Prabhakar, in this case, the CD is 0. There are some cases where the market is extremely bullish. Okay, at that time, for example, when the time the elections are happening, once if majority, let's say, are voting for BJP and BJP wins, the moment that happens, what happens is the predictions will be today the price is 420, the price might become 500, or the price might become 450. Both will be positive. In that case, you will have CU also, CD also. All right. Balaji, I didn't get your doubt. What is 500? Did I make some mistake? Oh, this looks to be correct to me. Once you're done, please let me know that you're done. Alright friends, so we are done with this question also. We got the same answer whatever we got earlier. Okay, so we have covered both risk neutral and binomial model. Now write down the next model's name, the Black-Scholes model. Friends, the Black-Scholes model was created by two people. What is the name of the first fellow? No, it is not just Black, it is Fisher Black. And what is the name of the second fellow? No, yeah, it is not just Scholes, it is Myron Scholes. These two people created the Black-Scholes model telling that binomial is complicated. Then they started going in depth to research to make a simple formula easier than binomial model. By the time the whole model got over and they came out and they saw outside, they realized that 6 years of their life was already over. Okay, and by the time the 6 years got over, they finally came up with a partly ugly, partly elegant formula, which is right now known as the Black-Scholes model. And this is the second formula in your SFM syllabus, which has got the Nobel Prize. It was the first one, CAPM, that is too easy. This is too tough, two extremes. The formula goes like this: value of a call is equal to S0 into ND1 minus E into e raised to minus RT into ND2, where D1 is equal to ln into SO by E plus R plus 0.5 standard deviation square whole into T whole divided by standard deviation root T. D2 is equal to D1 minus standard deviation root T. Can you please write down this beautiful formula in your books now? After which I'll tell you the logic. Here there is hardcore statistics involved. I'll tell you the logic of the formula. Statistically something is there which you have to by heart. Alright friends, have you all put up till here in your books now? Balaji, I'm not very sure. I didn't call with them and check with them whether they are alive or dead now. It really doesn't matter. This formula is what matters here. If you want, I'll cross check how old they are, what they are doing. They should be alive here. They should not, they wouldn't have died so far, anyways. Yeah. The formula got the Nobel Prize in 1990s, that time. So it's 30 years after that. So if they are around 60 at that time, now they must be gone. So we have to check that. Can you please check and get back to me on that, Balaji? That's an assignment for you. Yeah. All right. Now let's understand the logic of this formula. I will explain to you what actually is happening. Suppose the spot price is 100, the exercise price is 110. Okay. After 1 year, the S1 becomes 120 rupees. As a buyer, will you exercise or will you lapse? You will exercise. And once you exercise, the buyer should actually make a profit of how much? 10. So if the buyer is making a profit of 10, the minimum premium that I should charge today will be 10 divided by 1.1, that is 9.09. Am I right? Can I put this in a formula terms? So can I say value of a call is equal to present value of 120 minus 110, right or wrong? Or can I say that is nothing but value of call is equal to present value of 120 is S1, 110 is E1. Okay. Or can I say value of call is equal to present value of S1 is S0 minus present value of E1 is what I call it as E into E raised to minus RT. Am I right? If you now go and check the formula, S0 is what we started off over here. Okay. E into E raised to minus RT is what I put it over here. This is the first part of the logic. So basically it is nothing but value of a call is nothing but the spot price minus the exercise price. Can you write down till here in your books? Thank you, Balaji. I think Balaji will find these people and shoot them for making this formula. Now, have you all written down till here, friends? Once you write down, please let me know that you are done. Oh God, Scholz is alive, Black has died. Very sad. Now Balaji will go and find Scholz, shoot him also. Why should he also live? Is it? Oh God, so that is the anger that Balaji is having against this Black and Scholz. Okay. Anyways, thanks for this information, friends. Alright, friends, have you put up till here in your books now? Okay. Let's do one thing. If you have done till here, now I will go. Only part left for me to know explain is what is this ND1 and what is this ND2. I will explain that also. We understood why we are doing S0 minus E into E raised to minus RT. Am I right? What they do is by putting this ND1 and here by putting ND2, these are basically probabilities. I can say that as ND1 is the probability that should be multiplied with the spot market so that we can get a corrected adjusted spot market. Let us say for example if ND1 is 100%, that means the spot price will remain the same. If the ND1 is let's say 1% means spot price if right now is 100, it will come down to only 1 rupee. So basically from that we will understand whether we will exercise or we will lapse the option. And ND2 is the probability to be multiplied with the exercise price. So basically, higher the probability, higher the chance, lower the probability, lower the chance. Keep it that way. If both were, let's say 100 means today what is the spot price? At the end of 1 year, exactly the same thing will be the spot price. E, if it's 100% means exercise price also exactly the same, then we will understand whether we should exercise or we should lapse. So this is basically a kind of an adjustment factor which is used to determine the value of a call. This adjustment factor is mathematical. That is why we find this part complicated. So friends, my request to all of you is that once you understood what is S0 and what is E into e raised to minus RT, these parts are probabilities which we will find out using detailed formula. Can you write down this in your books now? Poor Black. He only worked hard and people are here waiting to kill him. Alright friends, have you put up till here in your books now? So now to find out ND1, I will just explain this part to you also. We will do it here only. See, ND1, first we find out D1 and from D1 we find out ND1. It is something like D1 you have seen there is something called as ln into SO by E. So I would say D1 is actually logarithm. If D1 is logarithm, what will be ND1? ND1 will be the anti-log. That's what they do. Similarly, here first we should find out D2 and from D2 we should go and find out what ND2. So ideally friends, for solving Black-Scholes model, we are going to use 5 steps. First we will find out D1, D2, then we will do ND1. This we will do using a normal distribution curve. Alright, and then we will also find out ND2 also using this, and finally we will apply the formula to find out the value of a call. Can you write down these 5 steps in your books now? Friends, just a news has come. ICSI has postponed their exam. They haven't cancelled it. ICI is still quiet, so you still have exams. So do not, become relaxed now. Deepika, yes, values will be given in the exam. I will be explaining that to you. Okay. Gauri Shankar, can you please explain why we use continuous compounding in the last problem after the class? Gauri Shankar, I'll explain that to you. See, all derivative we should use continuous compounding only. But the problem what happens is sometimes the rates given are already continuous compounded. If the rates given are already continuous compounded, you should not do continuous compounding once again. That will become double trouble. Are you understanding my point? So, continuous compounding is a must when it comes to derivative. Now, in fact, the question on Black-Scholes model that we are going to do, they have used the word CCRFI. CCRFI means continuous compounded risk-free rate of interest. That is nothing but already continuous compounded. So we don't have to again do continuous compounding on top of that. That is the logic of this. I hope you are clear with this part also, friends. Alright. So now let's do one thing. We'll do a proper question. So once we do a proper question, you will get a full grip on Black-Scholes model. All right. Everyone take this question. I'll give you a minute's time. Read through this question, understand the question, after which we will do it together. AJU, ICI, you meant ICSI, right? Company secretaries, right? ICAI, no, nothing has come yet. Am I right? All right. Please read through this question. All right, friends. Now, this was the only one question which has come in the exam so far, and they will never twist a question on Black-Scholes model. Okay. Because they should know how to twist a question, right? This is the max that can come. So, one this question you do, you work it out 2 times, it's more than enough. They have given the share price as 120, exercise price is 115, duration 3 months, standard deviation is 0.6, and CCRFI is given as 10%. They are asking you to find out the value of a call using what model? Using the Black-Scholes model. So friends, 3 months means 3 by 12. 3 by 12 is 0.25. Alright? Okay. So now let's do it together. I will write down working note number 1, D1. Okay. I will draw a table for this, that is particulars, computation, and what is the last one? Result. Alright. So here I will write down ln into SO by E. Point number B will be R plus 0.5 standard deviation square into T. Point number C will be standard deviation root T, and point number D will be D1. That is nothing but A plus B divided by C. This is exactly the way how we are going to do it. Yes, Deepika, the model itself is twisted, but once you repeat the same thing again and again and again, it will go deep down your subconscious mind, after which even if you want to forget, you cannot forget. So let's do this now. Log of S0 is 120 and the other one is 115. We will get the answer as 1.04. Friends, I have already shared with you a table called as a natural log table. Can you please take that table now? I will also take that table. There's a heading called formula tables, natural log table. Everyone, can you please take this natural log table? Okay. In this natural log table, we need to find out the value of 1.04. This is 1 and this one is 0.04. So this is the value. The value is already highlighted so that you don't find any difficulty. It is 0.03922. I hope everybody is clear with this answer. So I'll come back over here and I'll write down. This will be nothing but 0.03922. Okay. R is 0.10 plus 0.5 standard deviation square. Standard deviation is 0.6. Okay. Square into 0.5 will be 0.18. Whole multiplied by 3 by 12. So that will be 0.28 into 3 divided by 12. You will get the answer as 0.07. Standard deviation root t will be 0.6 into square root of 0.25. That will be 0.5. So I'll get the answer as 0.30. So the D1 will turn out to be 0.03922 plus 0.07 divided by 0.3. You will get the answer as 0.3641. Can you please write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay. Once you have put up till here, let me go to the next part. Once we get D1, next part we will go and find out D2. D2 is nothing but D1 minus standard deviation root T. So it will be 0.3641 minus 0.6 into square root of 0.25. That is 0.3. So I'll get the answer as 0.0641. Can you write down this also in your books? Ratna Kumari B, I did R is 0.1. 0.5 standard deviation square, that is 0.6 into 0.6 into 0.5 is 0.18. Whole multiplied by the time. Time 3 months means 3 by 12. I get the answer as 0.07. Alright friends, can you write down this in your books now? Alright friends, have you all put up till here in your books now? Okay, once you get D2, the next part that we have to do is, I have to find out ND1. Okay, ND1 friends, what we do is we'll take the Z value table now. Okay, in the Z value table, 0.3641 will correspond to what? Let's go and check. Next to the natural log, we are having the Z value table for 0.3641. This is 0.3. I'm highlighting it. This is 6. I'm highlighting. So the common area for 0.3641 will be this one. Yes, this is turning out to be 0.1406. Can you see this friends? Okay. So what I am getting is that 0.3641 corresponds to 0.1406, after which I will draw a normal distribution curve. Okay, in which on the right side I will get 0.1406. Before even I put these things, let me explain to you this normal distribution curve you learnt in foundation. It has got basically 4 rules. Positive values will go on the right side. Negative values will always go on the left side. If the requirement is greater than, I should shade the right area. If the requirement is less than, I should shade the left area. Now here, since the value is positive, this is plus, it will come on the right side. Okay. And one thing you have to keep in mind, friend, we will always shade the left area as far as the Black-Scholes model is concerned. That is how it has been created, so that we always shade only the left area. Alright. So this is minus 0.5. From there till here is 0.1406. So my value turns out to be 0.6406, that is 64.06%. Can you write down till here in your books, friends? Alright friends, once you are done, let me know. Alright friends, if you're done with this, I will now show you ND2 by which you will be totally strong in this whole concept. Okay. So ND2, next working note will be ND2. Friends, we got the answer as 0.0641. Now I will take the Z value table and check what does it correspond to. 0.06, oh sorry, yeah, 0.0641. So this is the thing. This is corresponding to 0.0239. Alright, so this corresponds to 0.0239. I will again draw the normal distribution curve. This being a plus value will come on the right side and the requirement is less than, so I will focus on the left area. Alright, minus 0.5. I'll get the answer as how much over here? 0.5239. Can you write down till here in your books? That is nothing but 52.39%. This 5-step methodology will make it very, very simple for all of you to understand and do it. Alright, Chitra is done. Aditi is done. Let others also finish. Okay. Alright friends, if you are done with this, then I'll go to the last part. And I'll write down value of a call will now be S0 into 64.06% minus E into E raised to minus RT. Friends, e raised to minus RT is already continuous compounded, hence I will not use the continuous compounding again. 10% is for 1 year. 10 into 3 by 12 will give me 2.5%. So that's why I did into 1 divided by 1.025. Okay. Into 52.39%. So my answer will be 76.87 minus 58.77. I'll get the answer as 18.10 as a value of call. Susan, practically less than denotes that what is the probability that the price is less than so much, or what is the probability that the price is more than so much. This logic is also applicable in QT, costing old syllabus, PERT, program evaluation and review technique. Alright friends, have you all put up till here in your books now? Okay, so we are done with the first part of the question. Now we will go and read the second part of the question. If the value of the call is 16, what action will you follow? The next working note heading is action if the value of call is how much? 16. Now listen, what is the actual value of call? 16. What is the theoretical value that we got using Black-Scholes model? Have we got it as 18.1? So the actual value, is it lower or higher? It is lower, means can I say that the actual value is actually undervalued? Very soon the price will go up. So what am I supposed to do? I am supposed to buy calls. Can you write down this also and finish it off? Alright friends, are you done with this part also? Okay, so we are done with this and we are done with this question on Black-Scholes model. Friends, there's one question, you work it out 2 times and then you see this will become very easy, and then if it comes in the exam, you will be the only one of the few people who can do it. As I told you on that date, start counting when it starts paining. So if you can do the same thing what others are doing, you have no value. But if you do something what others cannot do, that is where you create a value for yourself. Friends, let's go to the next question now, which is actually not a question. It's only another methodology in which Black-Scholes can come in the exam. Just read through it, then I will tell you how we will solve this. Can you please go through this question? Okay. So friends, here they are saying if D1 is equal to 0.55, how much will be ND1? Very simple question. So first what I have to do, I have to go and check the Z value table. Am I right? Let us check the Z value table, where I need to check the value of what? 0.55, is it? Okay. 0.55. Okay, so 0.55, the value actually corresponds to 0.2088. Once I get this, I can draw a normal distribution curve. This will come on the right side, 0.2088, and the requirement will be less than. So minus 0.5, 0.2088, I'll get the answer as 0.7088. Or can I say ND1 is nothing but 70.88 percentage? Can you please write down till here in your books now? Alright friends, have you got this answer? Friends, the purpose of giving you this was not to explain this part. Sometimes what will happen is in the exam, what they will do is they will give you the tables given below. One tail area, two tail area, or they will give you the cumulative area. So they won't give you the Z value table. Instead, they will give you one tail, two tail, or cumulative. How will we be able to find out? So let's do the solution one by one. I will start with the first one, that is one tail area. Everyone tell me in one tail area what is the value of 0.55 given over here? Is it given as 0.2912? What you have to do is you will have to do 1 minus 0.2912. If you do this, you will get the answer as 0.7088. Is this the same answer what you got earlier also using the long method? Sometimes in the exam they will give you the two-tail area. Here the value of this table is given as how much? 0.5823. So in exam, if they provide a two-tail area, what you should do is first you should convert the two-tail area into one tail. That you, how will you do it? 0.5823 divided by 2. Once you do like this, you will again get the same answer of 0.7088. The third one is we can also find out the same answer using cumulative area. Cumulative area 0.55 corresponds to 0.7088. So here no hard work is required. You will directly get the answer. So friends, the moral of the story is you have to pray to God that in exam they provide you the cumulative area for finding out the ND1. Okay. Can you write down this in your books now? Balaji, you have a good doubt. If 64 and 52.39 are probabilities, why the sum is not equal to 1? Binomial model, the both were interlinked probabilities. Here, 64.06 is a probability for the spot market, which means 36% is the probability that it will not happen in the spot market. That is the logic of that. 52.39 is the probability in the option market. Balance, that is, I think 48% will be the probability it will not happen in the option market. That is how the total tallies with 1. Are you clear with that now? Alright friends, are you exhausted? I think 3 hours is becoming a bit draining on all of you, is it? Just chat and let me know what is your energy levels now. No response. I just asked you a question, friends. I hope my chat box is active. Are you exhausted or can we move on for one more hour? Are your energy levels coming down because of the stressful topics like options and futures, etc.? Ratna Kumari is average, Sharanya is low, Shubham's spirits are high, Aishwarya is low. Good to continue. Sai Reddy, heavy load, Sharanya low, Vandanan Kili Poi. Yeah. Okay, that's a Malayalam terminology that he is exhausted. Ratna Kumari is on average. Ramani, how do I feel? Yeah. I'm a little bit exhausted here, but can we take a break and then continue? You mean to say a 5-minute break and then continue with the next one? Let's do one thing. We have only one more question pending in options in that case. That is that earlier one, 364897 that we did in international finance and we kept it pending. Let us do it and finish it off. Monday morning fresh we'll start off with interest rate derivatives. Let's not do that today. So anyways, we are having one more session on Monday. But you will have to do your homework and come back. Okay? Is that okay with all of you? So I think we'll be packing up by next 15 minutes. 1:15 it will be over. Rest we can do it on Monday. Alright? Alright. So friends, just one big request. Tomorrow is Sunday. You have a holiday. You don't have my classes happening tomorrow. You have to please go through the videos and then attend my class. It will become very, very convenient for you. It will hardly take you 1 hour or 1.5 hours because all the concepts are available here. Especially interest rate derivative is a complex topic. So if you learn and then we sit together, we can very easily crack it up and we can finish it off. I will just show you why is this coming this way. 1 minute. Portfolio, international finance options. Yes. If you look over here for interest rate derivatives, I'm having in total one FRA, IRO, IRF, interest rate swap. There are only 4 videos. But friends, if you view these 4 videos and you come on Monday, it will become extremely easy for me to explain the whole thing to you. Can you please do that? No, Mansi, Sundays I don't take classes. Family is also a priority. Next class is on Monday. That will be the last class with which we'll pack up with our whole part of SFM. So Monday what we'll do is we'll do 7:30 to 9:30. All right. Then maybe we'll do 11 to 2, or we can do maybe after 1 hour, 10:30 to 12:30. Let's see how much time it takes. I don't think it will take too much of time. Hopefully the our session it should get over. All right. Okay. All right, friends. Please do this and come on Monday. Okay. Tomorrow this is one very important homework to all of you. Let's now go to that pending question on international finance. All right, friends, let's write down the basic data again now, because you must have lost a bit of a track of this question. Let's write down working note 1, basic data, dollars payable $364,897. Shubham, the timings are the same, 7:30 to 9:30, 11 to 2. Babita, theory part, I will definitely share with you how you can learn theory. Alright, we'll do that on Monday. Dollars payable is 364,897. Table I don't need to copy. They have told that the contract size is 12,500 sterling. I'll write down over here. 12,500 sterling. Option premium for GBP at a strike price is $1.7 bar GBP. So the strike price or the exercise price is turning out to be $1.7 bar sterling. Okay. Premium for call is $0.037 bar sterling. Premium for put is turning out to be $0.096 bar sterling, and the duration is said to be 6 months. Can you please write down till here in your books now? Ratna Kumari, if we get time, surely I'll explain the concept of factoring on Monday. But first, let's focus on interest rate derivatives, which is also a heavy topic. And I'm also planning for some weekly one revision lecture on one particular topic. I have not yet decided on that. That depends upon how the exams are happening. Alright. So if that's the case, if I'm not able to do it on Monday, I'll definitely do it in the coming week. Okay. Once you're done, please let me know that you're done. Fine, friends. Now let's do one thing. Let's start solving the problem. They have given the contract size. So what I'll do is next working note will be amount payable under option contract. So what I will do over here is that I will go by the following steps. Step number one will be number of contracts. Okay. Point number A, dollars payable is $364,897. Exercise price is 1.7 dollar bar sterling. Yes, AJ, I'm planning weekly live sessions. Just subscribe to my website and my Telegram channel at least, because that is where I'll be announcing these parts. Exercise price is 1.7 dollar bar sterling. Okay, so the sterling payable will be 364,897 divided by 1.7, that is 2,14,645 sterling, right? So once I get this answer, we know the contract size. What is the contract size that is mentioned over here? Is it 12,500 sterling? Therefore, the number of contracts will turn out to be 17.17 contracts. Can you write down till here in your books now? Once you're done, please let me know. Alright friends, have you all put up till here now? Fine. Let me now continue writing the next part. If this is the case, in that case, we cannot do 17.17 contract. So what we will do, out of 17.17, we will enter 17 contracts in the option market. Balance 0.17, I can either do no hedging or forward. This question I will do it using forward. Can you draw this chart in your books now? Ramani, the general currencies involved is dollar and sterling. Alright, which means if in total we were getting 214,645 sterling, now we won't be getting so much. We will do it in the ratio of 17:0.17. So this would be 214,645 divided by 17.17 into 17. That will be 212,520 sterling will come over here, and 0.17 would be 2,125. Similarly, If it is $364,897, now the whole thing will not come in the ratio of 17 is to 0.17. 364,897 divided by 17.17 into 17 will be 361,284, and here it will be the balance, that is 3613. Can you please draw this chart also in your books now? Alright friends, have you all put up till here in your books now? Okay. So once we are done with this, then I'll write down step number 2, amount paid in the option market. Okay. So what will happen is inside this, I'll write down point number A. It will be not 364,897, no, it will be 361,284. 361,284 is the dollars that is payable. Now the next important question is whether it is going to be a call option or whether it is going to be a put option. This can be decided with the help of the same picture that we draw to decide whether it is bid or ask. So this picture is actually comprehensive. If I have dollar payable, what will I do? I will buy dollar. In return, what will I do? Sell sterling, buy sterling, sell dollar. Dollar bar sterling. For determining bid or ask, we ask two questions. What is the commodity? What is the bank doing? Hence, we get the answer as bid rate. For call option or put option, we ask two questions. What is the commodity? What is the person doing with the commodity? He is selling sterling, right? For doing this, what does he want? He needs a right to sell. What do you call the right to sell? It is called as a put option. Hence over here, what option will be applicable? Put option will be applicable. So now sterling payable will turn out to be 361,284 divided by what was the exercise price? 1.7. Once I do that, 361,284 divided by 1.7, I will get the answer as 2,12,520 sterling. This must be the same answer that you got earlier. Yes or no? Yes. So once I get this, this is the sterling payable in the option market. Alright, can you write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay. Alright friends, so once we get this, I will now write down step number 3, option premium. That is the next part that I have to worry about. Now, point number A, put premium. Everyone tell me how much is the put premium that I am getting over here? It is 0.096 dollar bar sterling. Am I right? Okay. So total premium will be 361,284 dollar divided by 0.096. Sorry friends, it will be the sterling. Sorry, how much is the sterling that is available over here? 212,520 sterling. 212,520 sterling into 0.096 dollar bar sterling, because sterling is the commodity. This into 0.096 if I do, I will get the answer as $20,400. Alright. Now tell me, where am I? Am I in UK or US? I am in UK, so I need to get sterling for this. For which I will use a spot rate, because premium has to be paid upfront. What is the spot bid rate or ask rate? It will be the spot bid rate. Okay. Therefore, $20,400. What is the spot bid rate? 1.5617 dollar bar sterling. I will divide. Once I do this, I will get the answer as 13,063 sterling. This is step 3. Step 4, balance payable in forward market. Whatever is remaining, I have to pay in the forward market. How much is remaining? 3613. Be 3. Okay, 1 minute, friends. Sorry. There is a correction here also. 13,063 is a premium payable now or on expiry. It is a premium payable now. So we have to convert this and make it on expiry, because rest everything is payable after 6 months. So interest on premium, assuming that I don't have money today, I am borrowing money for paying premium. It will be 16,063 into sterling borrowing rate is how much? 7. That will be 3.5%. That will be 457 sterling. So total premium plus interest will be 13,063 plus 457, that is equal to 13,520 sterling. Can you write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay. Once you are done with this part, so we are done with option premium. Now I will write down step number 4. Balance payable in forward. Okay. How much was the balance coming over here, friends? 3613 divided by, it will be the bid rate. So what is the forward bid rate? 1.5455. Multiply it into 1.5455 dollar bar sterling. No. 1 minute, friends. Sorry, this is dollar, right? This is dollar. So this will be divided by. I'll get the answer as 2337 sterling. So my conclusion will be, I have to add up these three numbers. One is option, other one is premium, and the last one is forward. Like that I will find out the total outflow. Am I right? So for options, it turns out to be how much? 12,520. For premium, it was 13,520. and forward is 2337. So the sum total will be 2,28,337. We are done with this enormous question, friends. Please write down and finish it off. Alright, friends. Have you all put up till here in your books? Fine, so we are done with this also, and let us conclude today's session with this. Now, Monday we'll have our final session that will be on interest rate derivative, friends. Please revise those parts and come, especially interest rate swap. That is very complex. So, once you revise, it will be easier for me to take the whole thing and finish it off. Alright? So, shall we pack up today's session, friends? Before I wind up, I'll just share with you one more part which is very, very important, which has helped me to learn a lot of things. This will help you also. Friends, here I have written now that fear is a choice. We are all afraid of many things, and it is said that fear is one of the main reasons many people do not clear or do not get through the exam. It is actually interlinked, your belief and your fear. The higher your belief, the lower will be your fear, and vice versa. Today I will share with you one of my own life experiences on fear, which actually helped me to transform my life. And this goes back to a very, very wonderful date. It goes back to 15th August 1997. Friends, what is the speciality of this date? This was the date when India actually became independent. Not only that, this was exactly 50 years of independence. So at this point of time, I was in school. I was hardly 10 years old at that point of time. And everybody was very much excited with, everything happening in the school. And, they were all, some people were, talking about Independence Day, some were writing about independence, some were drawing India's map, some were drawing Mahatma Gandhi, etc., etc. That is when my English teacher came to me and told me, Tarun, you should go and speak on Independence Day. As a kid, who has never gone on stage, I have seen many people going on stage. That looked very normal to me. So I thought, let me say yes. So I agreed to the teacher and I went back home very happily. I told my mom, see, I'm going to speak on the Independence Day. My mom helped me to make a very nice speech, which I was about to go and deliver over there on 15th August 1997. I still remember the first two sentences that I mentioned in the speech. I still remember it now. It was very simple. It started off like this. 50 years back, India was under the rule of British. Then Mahatma Gandhi, the father of our nation, came, and with the tools of ahimsa, etc., he made India free. This was the bottom line of the whole thing. I went there and I started speak. I wanted to speak. So finally the day came and the program was about to happen at 10 o'clock. 9:30 we reported backstage. That is the first time that I felt my legs started shivering. I had never had that feeling before. There were four people in front of me. One by one they were going up, they were speaking and they were coming back. Correctly they were speaking here. Now by this time my hands started shivering because I was the next speaker to go on stage. That fellow also went, spoke beautifully, he came back. Now it was my chance to go up and speak. Finally I took the courage, I walked up on the stage. The moment I reached on the top of the stage, I could see a crowd of around 50-60 people sitting there and staring at me. That moment I blacked out. Suddenly my hands started shivering, I couldn't see anything in front of me. My teacher caught me, put me in front of the mic, adjusted the mic and gave me a tap. Come on Tarun, start speaking. What to speak? I have forgotten my complete speech. In that high tension, I could feel my heart come out. And in that high tension, instead of saying 50 years back India was under the rule of British, I ended up saying that yesterday India was under the rule of British. Now, just like you people are sitting and laughing, everybody over there started laughing. I became even more nervous. I told, sorry, not yesterday. Today, India is under the rule of British. After that, for the next 40 seconds, people went on laughing and I went on talking what I don't remember. 40 seconds I spoke and I ran and came out on the stage. The worst day of my life. And to add more salt on the wound, when I'm walking back home, these kids are walking back with their parents. So they will call their parents and say, look, dad, this was the guy who spoke on the stage. That day I decided, to hell with public speaking. I will never go back on stage. I will never speak in front of a crowd. Life went on as if nothing had happened after that. Anytime somebody tried to catch me to speak, I will run away from that place or I will tell I have fever. Like that, slowly and steadily, my plus 2 got over, my college got over. I went to CA in Chennai. There is a center even now called as Maruti Coaching Center. I did my taxation classes over there. One of the faculties, TG Suresh sir, what he makes us do is every day morning 6:30 the class starts. 6:15 to 6:30, one fellow comes on the stage and he revises the previous day's lectures. So like that, Suresh sir one day asked somebody who would be willing to come on stage and speak. I will be the last fellow to raise my hands. That is when my neighbor took my hands, put it up. And Suresh sir told, okay, you will speak tomorrow. What wrong did I do to this guy? These people, they don't raise their hands, they will raise their neighbor's hands up. I got so freaked out and suddenly all that fear came back in my mind and I went back to sir and told, sorry sir, I cannot speak tomorrow, I will not be well, I am not coming, etc. etc. So Suresh sir saw the way I got freaked out. He told me, don't worry, you relax, don't speak tomorrow. I went back to my friend with anger and I told him, how dare you raise my hands? My friend also got scared. Then I told him the whole story, 15th August 1997, blah blah blah, etc. That is when my friend gave me back one beautiful advice which stuck in my mind. He told me, 1997 you spoke, people laughed, those people are gone. You are still here in 2008 and still with the same fear. If you speak today, maybe people will laugh. But next year, they will forget. You will at least have tried and you would have tried to fight your fear. With that, I decided that I will go and speak. I went to Suresh sir and I told him, sir, not tomorrow, next week I will surely speak. Then that 1 week was terrible. I was by-hearting this section 37, income tax, very basic general deduction section. But for me, that was a Herculean task because I had to speak. The day of the speech, I got up at 3 o'clock in the morning and I was standing outside my room and recalling. People were walking thinking I'm crazy. Then 5:30 I reached the classroom. Now nobody was there, only I was there. That is when an idea struck me. What I did was I went and gave the overview on the board so that others will feel I have given the overview, but for me that is going to be my emotional support. After I wrote down all the bullet points, finally the class came. There was a crowd of around 250 plus students. Again the same feeling, heart started beating and I was all nervous, one moment of blackout. I just turned back to the board. I said, friends, today's topic we are going to discuss this, and this. That 10 seconds was required for that fear to wash out. After the 10 seconds, I started speaking with the confidence that there is a board behind me where all the things are written, as if I have been teaching for my whole life. I could speak smoothly for the next 15 minutes, which went up to 20 minutes. And finally, friends, when that speech got over and when that batch was about to get over, I was awarded as one of the main best speakers of that batch among a crowd of 250 students. That day, I decided that I will take up teaching as my profession. And that is how today I am here, standing here and speaking in front of you. Friends, a very big lesson that I learned that day was, had I not took that choice of fighting my fear and standing there and speaking, today I would be somewhere else doing something else. By just fighting one fear, I could raise my life to a very different level and I'm living my life with full satisfaction and happiness as how I want to live. So friends, my message to all of you is that what is holding you back is fear. And the only way you can fight your fear is by just going and doing the things that you are afraid of. So from now onwards, if you're afraid of something, do not back out. face your fear, look into the eye and do it, and finally break that fear, because the more fears you break, the more successful you will become. Thank you so much, friends. See you back on Monday morning. Have a nice time ahead. Thanks a lot. Vandanan, amazing year. So you are very young now to become a CA. Yeah. Thank you so much, everyone. Manasi, that question, can you please WhatsApp me? I will check and get back to you on that question. All right.